The Fed just quietly turned the liquidity tap. Here's what that really means. The Federal Reserve just made one of its most important decisions of the year, and most investors completely missed it. Everyone's talking about the latest interest rate cut, a simple quarter-point drop that made headlines. But the bigger story, the one that could quietly boost markets into 2026, is happening behind the scenes. On December 1st, the Fed will officially end quantitative tightening, or QT for short. That might sound like a mouthful of financial jargon, but don't worry. By the end of this video, you'll not only understand what QT is, you'll see exactly how ending it could quietly pour more fuel into the financial markets. Stocks, bonds, even your savings account, without the Fed cutting rates again. So let's slow down and unpack this step by step. Part 1. What even is the Federal Reserve and why do they matter? Before we jump into QT, we need to understand what the Federal Reserve, the Fed, actually does. Think of the Fed as the financial traffic controller of the United States. It's their job to keep the economy running smoothly, not too hot, not too cold. When things slow down, they lower interest rates to encourage borrowing and spending. When things overheat, like during inflation, they raise rates to cool things down. But interest rates are just one tool. The Fed also controls something much bigger, its balance sheet, basically all the assets and money it holds. When the Fed buys assets like US Treasury bonds or mortgage-backed securities, that's called quantitative easing, or QE. You can think of QE like pumping extra oil into the engine. It adds liquidity, meaning more money is flowing through the system. When the Fed sells or lets those bonds mature without replacing them, it's doing the opposite. Quantitative tightening, or QT, draining liquidity out of the system. That's what's been happening since 2022, and now it's about to stop. Part 2. Why did the Fed start QT in the first place? During the pandemic, the economy nearly came to a standstill. To keep things from collapsing, the Fed went into emergency mode. They dropped interest rates to near zero and started buying massive amounts of bonds. By mid-2022, the Fed's balance sheet had exploded to nearly $9 trillion. To put that in perspective, that's about 1/3 of the entire US economy. This flood of cheap money helped businesses survive and the stock market boom, but it also had side effects. Too much money chasing too few goods fueled inflation, prices rising faster than paychecks. So, starting in June 2022, the Fed began to reverse course. It stopped buying bonds and began letting them mature. That's QT. In simple terms, it was like the Fed slowly draining water out of an overfilled bathtub. When QT began, the goal was clear. Make money a bit scarcer, raise borrowing costs, and bring inflation down. And it worked, at least partly. Inflation cooled from above 9% to near target levels today. But QT also had other effects. It made it harder for banks to lend, and it tightened liquidity across financial markets. That brings us to now, November 2025. Part 3, what just happened, and why it's a big deal. At the end of October, the Fed cut interest rates by 0.25%. That was the headline everyone saw. But buried deeper in the announcement was something arguably even more important. On December 1st, the Fed will end quantitative tightening 3 to 6 months earlier than Wall Street expected. That means instead of shrinking its balance sheet, the Fed will start reinvesting money from bonds that mature. Specifically, it will take the money from maturing mortgage-backed securities and buy short-term Treasury bills, the safest, shortest duration debt in the US government system. In simple English, the Fed won't be pulling money out of the system anymore. It's going to keep it circulating, and that subtle change can ripple through every corner of the economy. Part 4. Why does ending QT matter so much? Let's use an analogy. Imagine the entire financial system as a giant aquarium. The Fed controls the water pump. When they do quantitative easing, they pump more water in. When they do QT, they let some water out. Too much water and fish, that's banks, businesses, and investors, swim too fast, prices rise, bubbles form. Too little water and fish struggle, loans dry up, markets panic. By ending QT, the Fed is saying, Okay, the tank is stable now. Let's stop draining it before the water gets too low. That's good news for markets because it removes a source of pressure. When the Fed was doing QT, private investors had to absorb all the bonds the Fed was letting go, hundreds of billions of dollars. That drained money that could have gone into stocks or business investment. Now that drain stops. That money can go back into the system, into riskier assets like equities, or into short-term lending markets that fuel economic growth. In technical terms, liquidity increases, but in everyday terms, it just means there's more breathing room in the system. Part 5, How the Plumbing Works, explained simply. You might wonder, where exactly does this extra money come from? It's not like the Fed is printing cash again, right? Think of it like recycling. When a government bond that the Fed holds matures, the government pays the Fed back. Under QT, the Fed would just let that money disappear from circulation. Under the new plan, the Fed will take that money and buy new short-term Treasury bills. So instead of removing that cash, it keeps it flowing inside the system. That helps stabilize bank reserves. Basically, the cash banks keep on hand to meet withdrawals and lending demands. Over the past year, those reserves had been shrinking dangerously low, and some analysts worried about another mini-crisis like the one in 2019 when repo markets froze. By ending QT, the Fed reduces that risk. It keeps the system lubricated, so to speak. It also helps the US Treasury Department, which needs to borrow trillions of dollars each year to fund government operations. When the Fed was shrinking its balance sheet, the Treasury had to compete harder to find buyers for its bonds. Ending QT means one more friendly buyer, the Fed itself, is back in the mix, at least indirectly. Part 6, Why now? So why end QT now, not next spring like everyone expected? First, liquidity was getting tight. The Fed's own data showed reserve balances at banks drifting lower. Ending QT avoids an accident, a sudden credit squeeze or funding shock that could break something in the system. Second, it's a way to ease conditions quietly without publicly cutting rates again. Rate cuts make headlines. They can look political. Adjusting the balance sheet flies under the radar but still helps markets function better. And third, timing. The US Treasury has a major quarterly refunding coming up on November 5th. That's when it announces how much debt it plans to issue, short-term versus long-term. With QT ending, the Treasury can issue more short-term bills without worrying about overwhelming the market. It's a coordinated dance between two of the most powerful financial players in the world, the Federal Reserve and the Treasury. Part 7, What it could mean for the markets. For stocks, this could act as a tailwind. When liquidity improves, investors tend to feel safer taking risk. That can mean more demand for equities, especially growth and tech names that thrive in low-rate, high-liquidity environments. For bonds, it's a bit more nuanced. Long-term yields might stay elevated if inflation expectations rise, but front-end yields, the short-term stuff, could see more stability as the Fed buys T-bills. That means less volatility and potentially a friendlier backdrop for bond investors. And for cash, particularly money market funds, there's already a record $7.4 trillion sitting in them. These funds mostly buy short-term government paper. Since the Fed will now reinvest into those same bills, there will be even more demand. That keeps the short-term interest rates steady and safe. So while the Fed isn't officially launching a new QE program, it's doing something that feels similar, a pause in tightening, which could quietly support markets through the end of the year. Part 8. Is this basically another rate cut? Some analysts say yes. They argue that ending QT is the equivalent of a quarter-point rate cut because it loosens financial conditions. Others disagree, saying it's just an incremental change, bringing forward a decision that was inevitable anyway. The truth probably sits in between. It's not the same as lowering interest rates, but it does boost liquidity in ways that can have similar effects. It's like turning down the air conditioning in a cold room. You're not turning on the heat, but you're making things more comfortable. Part 9. What could go wrong? Of course, nothing the Fed does comes without risk. First, there's inflation. If the economy keeps running hot and the Fed adds more liquidity, it could reignite price pressures. That would put the central bank in a tough spot. easing and tightening at the same time. Second, market complacency. When investors believe the Fed will always step in to help, they take more risk. That can inflate bubbles in tech stocks, housing, or crypto. And third, fiscal pressure. The US government's debt is climbing fast. Ending QT may help Treasury in the short run, but it also signals that the Fed is sensitive to financing costs, something that could spark political controversy down the road. Part 10. The key dates ahead. There are 4 key milestones to watch. November 5th, the Treasury's quarterly refunding announcement. We'll see how much new debt they plan to issue and how much of it will be short-term bills. December 1st, QT officially ends. The Fed stops shrinking its balance sheet. December 11th, the New York Fed releases its first schedule of Treasury bill reinvestments, the practical roadmap of how this will work month by month. Mid-December, the next Fed meeting, where we'll find out whether Powell and his team signal more rate cuts or if they pause to see how this liquidity shift plays out. Each of these events will tell us whether the Fed's move becomes a tailwind for 2026 markets or if it simply buys time before the next policy pivot. Part 11. How this affects ordinary people. Let's step out of Wall Street for a moment. If you have a mortgage, car loan, or credit card balance, this decision matters to you. The Fed's shift could help stabilize long-term interest rates, keeping borrowing costs from rising too fast. If you invest in a 401k or an index fund, more liquidity can mean smoother markets and fewer violent sell-offs. And if you're sitting in cash or a money market fund, the Fed's bill buying could keep your yields strong for a little longer. In other words, this isn't just about big investors. It's about how the financial plumbing behind the scenes shapes everyone's financial reality. Part 12. The bigger picture. Since 2008, the Fed's balance sheet has become one of the most powerful forces in the global economy. Every cycle, crisis, recovery, and slowdown has revolved around it. Now, in 2025, we're seeing a new phase. Inflation has cooled, growth is steady but uneven, and debt levels are sky high. The Fed is trying to thread the needle, supporting the system without overstimulating it. Ending QT early is a way of saying we've tightened enough. Let's stop before something breaks. Whether you see that as smart risk management or quiet capitulation depends on your perspective. But make no mistake, this is a major turning point in US monetary policy. Part 13. What to watch next. Over the next few months, here's what analysts will be tracking closely. Bank reserve levels. If they rise, it means liquidity is improving. Money market fund flows. If investors move money from cash into stocks, it signals renewed risk appetite. Long-term Treasury yields. If they stabilize or fall, it shows the market believes the Fed has things under control. And finally, inflation data. Because if prices start climbing again, the Fed may be forced to restart tightening sooner than anyone expects. Part 14. The takeaway. Here's the simple takeaway. The Fed hasn't restarted money printing, but by ending QT, it stopped pulling cash out of the system. And that, in today's fragile global environment, is enough to make a difference. Liquidity is like oxygen. You don't notice it until it's gone. And the Fed just made sure the economy can keep breathing a little easier. For investors, that could mean smoother markets. For borrowers, slightly easier conditions. And for policymakers, a little more time to balance the scales between inflation, growth, and debt. Part 15, closing. So the next time you hear someone say, the Fed cut rates again, remember this. The real story might be happening where no one's looking, deep inside the plumbing of the financial system. Ending QT doesn't grab headlines, but it quietly shapes everything from your mortgage rate to the S&P 500. If you learned something new from this breakdown, hit like, subscribe, and share this video with someone who wants to understand what's really driving the markets right now. And tell me in the comments, do you think the Fed ending QT is the start of a market rally or just a calm before the next storm?